Hello, everyone, and welcome to today's webinar, Retirement Income, presented by CapTrust Financial Advisors. I would now like to introduce Deborah Gates, Manager, Advice and Wellness with the CapTrust Participant Advice Team. Welcome, Deborah.
Thank you so much, Karina. It's a pleasure to be here today. I'm showing you this legal disclaimer. I'll not be reading through all of these disclaimers, but I would like to point out that within each retirement plan, there are different investment options, each with a different degree of risk. And it's important to understand the risk involved when choosing among them. CapTrust is available to help with investment decisions, but we don't offer tax, legal, or accounting advice. And so what I want to say to you, income in retirement, it means different things at different times. But today I am so excited because we're going to hear from 3 financial advisors who will speak to you at different points on your journey. And I'm so happy. Welcome, Jeremy. Welcome, Michelle. Welcome, Adam. I'm so excited about being here today. We are going to have a great time in speaking about what's going on with creating retirement income today. I'm really excited about this discussion. But before we get started, I want to just review the agenda with you. So today, as we primarily focus on creating income for those who are within 10 years of retirement, we thought we would be remiss if we did not include the importance of developing a financial plan that'll set the stage for those who are under the age of 55. So I want to start with the polling question just to gauge the pulse of our audience today. So Karina, I want you to launch this polling question that we have here today. And I just want you to choose the number of years that you have before you expect to start using the money that's in your retirement plan. And you're looking at creating this income. Do you have less than a year? Do you have 1 to 5 years, 6 to 10 years, 11 to 15, or more than 15? So Adam, what do you think? What do you think? What do you think it's going to be, the audience that we have? Just kind of give a couple of guesses here.
I bet there's a majority of folks that have more than 15 years that are looking to prepare for retirement income.
Yeah, what about you, Jeremy?
I'm going to agree with Adam on that one.
Okay, Michelle?
I was leaning to the 11 to 15 years bracket.
Yeah. I think it's just something that people are more interested in now because, you want to make sure, not only thinking about when you're going to retire, you want to make sure that you have enough income to take you throughout your years of retirement, to make sure that you can live the same life that you have while you're working. So this is going to be interesting to see. So, Karina, what do we have in sharing these results? And we see what those poll results. Did you close the poll, Karina?
Yes, I have shared it with everyone. Since your desktop sharing, you might not see them. So I will read it to you.
Yes, please.
5% said less than a year. 25%
Mm-hmm.
said 1 to 5 years. 25% 6 to 10. 18% 11 to 15 years. And 27% said more than 15 years.
Wonderful. Okay, so at least we know who we're speaking to. So what I can say is that there's going to be something that that fits everybody when we're having our conversation today. And so, through our working lives, that can seem long. Retirement still sneaks up on us. And creating retirement income, it's a process that you need to be thinking about really no matter where you are as it relates to your career. So even if you're 25 to 30 years from retirement age, which can seem like a lifetime away, there are things that you can do today to make sure that you'll be in good shape when you're within 10 years of retirement. So knowing what you may need will give you more confidence in getting to where you want to go. And studies have shown that people who are prepared reported being the most satisfied with their retirement lives. So I want to address this to Adam. I want to start with Adam. Adam, I know that you meet with a lot of people with varying time horizons. So can you tell us about your experience when you're working with participants? Oh, let's say they could be in their 20s or 30s, just that they're under 40 and they have more than 25 years before they're going to retire. What types of questions are you getting? What are they asking you?
Yes, thank you, Deborah. Being myself just over the cusp of 40, at 41, This is something that's always on the forefront of my mind, but also in my role at CapTrust, I help folks get set up in their employer plans. So that's a big part of my role. Especially in the under 40 category, the most reoccurring question that I get is, how much should I be saving? Which is a great question. Quite honestly, it'll probably play the biggest impact of your financial preparation of how much you can save. So when discussing, if you want to go ahead and go to the next slide, when taking a look at what should we be saving, somebody in their 20s getting started, we really recommend 10 to 15% of their income is what should be set aside for retirement as a whole. This would include any employer contributions that may be available to them through their employer plans. But overall, it's very important to pay yourself first. We're responsible for our income in retirement. So you really have to set that money aside starting as soon as you can. You will see based on this illustration that the longer you wait, it could mean the more money you have to ultimately save overall of your income. Now, how much you save and when you begin is just as important, if not more important, than how you invest your money. Take a look at the next slide for me, Deborah. This slide is going to talk about how saving earlier can really benefit you. So, there's an old adage that says timing is everything. Now, I'm not necessarily referring to timing the market, but the time that you can be in the market. This illustration here gives an example of two investors, and it really will stress the benefit of retirement plans because they can grow tax deferred or tax free, and the compounding growth will build over time. So looking at these two investors, investor A starts right away. They're able to save $150 a month over the course of 40 years with total contributions or savings of their own at $72,000. So over this 40 years, this comes to almost $300,000. Now, using the same expected return, investor B, who waited 10 years later, tried to save a little bit more on a monthly basis to make up for that. And so saving $200 over the course of 30 years was still a $72,000 contribution. It's almost $100,000 less in terms of total savings. Really shows you the benefit of saving as soon as possible and having a longer time frame to build your retirement balances will help overall. Now, the next screen itself, if you want to take a slot to the next screen for me, Deborah. And another question I get is, how much should I have saved at a certain age? And although this answer will be different for everybody, this is a great benchmark to put in perspective or to get an idea. The illustration on this slide will show different ages, and at those ages, how many times your salary you should have saved at that point. So for example, at age 40, someone should have ultimately 3 times their salary saved for retirement at that point. Now, this is not specific to everyone. This is not a must-have. So don't, hold this against yourself if you're not at that and disregard your savings. Everybody's saving and needs are going to be different. And that's the great thing with working with CapTrust is it's not on you to figure that out. We're here to help you figure out how much you should be saving and what your retirement goals are. Looking at this illustration, obviously as you get older, the more you should have saved and built up. But again, the benefit of the retirement plans is this is something that is going to grow for you tax deferred or tax free. So it's highly encouraged to take advantage of these tools, especially if you have a Roth option through your plan where you can have tax free growth. If you're an employer that has an HSA plan, you can benefit from some tax implications there as well. But overall, saving as soon as you can and saving a good amount, 10 to 15%, pay yourself first. You're not only helping to accumulate those balances, but you're helping to train yourself to live off less and live a certain lifestyle as well.
That's all great advice, Adam. I totally agree with trying to create different revenue streams, especially as you mentioned, using the Roth IRAs and Roth 401ks to get that tax-free revenue stream. And then another good way to diversify your income streams in retirement is to diversify with the asset classes you're using, such as using real estate to create a revenue stream.
You know, one thing, Michelle, that I hear a lot of people talking about recently, and I'll go ahead and talk about the elephant in the room, is cryptocurrency. So a lot of questions we get oftentimes is that a good corollary investment for my retirement plan? And I think when it comes to cryptocurrency and kind of hot topics like this, that as long as what you're using is right sized in your portfolio, you know, as long as that's not more than 5 or 10% of what you're trying to do, I think it's okay to dabble in those types of things. But just know something like a cryptocurrency investment is not aligned with most people's retirement plans, kind of gets out of the realm of what we would consider normal thing to invest in.
Jeremy, that's a great point. I actually get that question a lot, is how
You
can cryptocurrency be involved in my financial planning for retirement?
Yeah. So guys, thank you so much. Before we move on, I just want to say, I want to mention, if you're having trouble seeing the slides, you might just want to refresh your browser. I just want to speak that to the audience. So if you're having any problems with seeing the slides. So thank you, Adam. That was great. So that's for our group under 40. So Michelle, you're going to come in. How would you advise someone who's creating income, but they're currently in that 40 to 55 age group? I mean, this is an age range. You know, sometimes we call that sandwich generation, where you're taking care of parents and you're taking care of children. There's so many competing priorities. There's college education and the likes thereof. So how do you advise them at that point when they're between that 40 and 55 age? I think you're muted, Michelle.
Priorities. And the biggest mistake, my advice would be to avoid the biggest retirement planning mistake, which is to not save at all for retirement. But based on the number of participants we have, I'm sure that most everybody now is thinking about saving for retirement, which brings me to the second biggest mistake, which is not to save enough. And typically the obstacle to not saving enough is to prioritize college saving over retirement saving. And what you probably have heard, most of you, is that you can get someone to loan you money for college, but you can't get anyone to loan you money for your retirement. So what you want to do is prioritize retirement savings over college savings. Now, let's take a closer look at what considerations you need to make when you're planning for retirement income. What this chart shows you is, you know, what are all the different inputs that you have to consider when you're putting together your financial plan. And like Deborah mentioned, it's not something you have to do alone. You can speak with your CapTrust retirement counselor and they can help you work through some of these considerations. But I do want to point out a few of them now. So one consideration is, how much will I need? And the bubbles across the top of the circle addresses that. The first one is retiree spending. That goes to your lifestyle. What type of lifestyle do you have to fund in retirement? Your withdrawal rate at the top of the circle, and that really goes to how much can your portfolio sustain in withdrawals every year during retirement. Longevity, you want to consider, what does your family history look like? How long do people live in your family? Another consideration is, where will the income come from? And that's addressed with the bubbles coming down on the right side of the outside of the circle. And that's solvency. And where is your money at? Is it going to come from Social Security, which may not be enough for retirement? Is it going to come from a pension plan, which many of us no longer have those? Or is it going to come from your retirement accounts, or a combination of all three? So you want to think about, where will the income come from in retirement? Another retirement consideration for income is going to be, what can impact my retirement plans? And that's addressed by the bubbles going back up on the left side of the circle. And those are things like inflation, market volatility, taxes, healthcare expenses. So a lot of those we can't control, but we can plan for them. And another way to plan for them is to think about, how are you going to take money out of your accounts in retirement? What accounts are you going to use to save for retirement? Taxable accounts or tax-free accounts? So as Adam mentioned, using the Roth IRAs, Roth 401ks will provide you with tax-free income in retirement. And then you also can use health savings accounts, which a health savings account, or an HSA, is an account that you can set aside money pre-tax. It grows tax-free. You can invest it. It'll grow tax-free, and then you can take the money out tax-free for qualified medical expenses. And the only hitch with that is you have to be in a high deductible health care or health insurance plan. And those plans are typically plans that cover preventative services before the deductible is met, and that's all. So you just have to check with your employer to see if you're eligible to have an HSA account. And so what I'd like to go on and talk about is what happens with each decade of savings. And that'll be on the next slide. So when you're in your 40s, hopefully you're continuing to save, your income is higher, your bonuses or raises are higher, so you want to capture more of that in your 40s. You want to start estimating how much you will need for retirement. You want to look at your asset allocation of the accounts you're saving for and make sure that that your portfolio with that asset allocation can produce the return that you need to make your retirement goals. And having a financial plan, knowing what that target rate of return is key to managing it. You also want to, in your 40s, is if you haven't had a will made yet, you want to get a will made, especially if you have children. You want to make sure all your children, if that's your desire, are accounted for in your will. And you also want to make sure that if you've gotten divorced along the way, that who's in your will as your beneficiaries and on your retirement accounts as beneficiaries is actually who you still want to inherit your assets. And then moving on to your 50s, now in your 50s is when your lifestyle is essentially set. And you really want to maximize your savings. You want to utilize a tool called catch-up contributions, which allows those who are 50 and older to save more into your 401k accounts. And this year it's $6,500 in addition that you can save in your account. That number changes periodically. You want to eliminate debt in retirement. And really in the 50s, what you want to do is move on to looking at, can I live and support this lifestyle in retirement, or will I need to live on less, which is shown on the next slide. So the big question, can I live on less than what I currently earn in retirement, is prevalent on people's mind when they look at what they've saved for retirement and they're coming up on it. Usually what you have to consider is what puts you in the best position to do that. So if you eliminate debt, you have more retirement confidence. So in your 50s, leading up to retirement, your goal is to be debt-free in retirement. You want to pay off the mortgage, pay off credit cards. You want to make sure you've had a really good understanding with your dependents. College kids, lay down the ground rules about your ability to support others when you're no longer working. No one likes to have financial surprises in retirement, so you want to make sure everybody understands what the situation will be. You want to do an honest assessment of your lifestyle and your healthcare needs and look at that in conjunction with your plan. If you do have health issues, you'll want to make sure you're saving more to be able to cover those health expenses in retirement. So do an honest inventory and say, can I live on less? What lifestyle do I want to have in retirement? Do I actually want to have a bigger lifestyle in retirement? And that's okay too, but be honest, look at it early, plan for it. And then you want to have an emergency fund. That is really, I call it insurance for your portfolio, because if you can go to your emergency fund, you can avoid having to dip into your retirement savings and protect your lifestyle in retirement.
I agree, Michelle. I think that's so important. Self-awareness is so important. And to thine own self be true as to how you're really going to live in your time of retirement, and really think about those things as to what you have and what you're going to need. And so thank you so much for that information. I think that's a wonderful segue into our next polling question. So Karina, Can you start this polling question? Have you ever figured out how much income you might need in your time of retirement? Yes, and I'm fairly confident in my plan. I have, but it's been a while. I know that I should, but I haven't. I don't have any idea where to start. So just like before, so Michelle, that was great information that you gave, and I think that will probably help people answer this question even better. So how do you think we're going to fare on this one?
I think it's going to be, I have, but it's been a while.
Yeah, yeah, that's what I love about the webinars offered by CapTrust. It's really not for you to have all of the answers right now, but what we really want to do is we want to stimulate you to start thinking about these things and start reaching out to the various avenues and to call CapTrust, because we are here, we are readily available to speak with you. We have people on the advice desk, our retirement counselors that can speak to you and help you to figure out what it is that you need to do. Because not only do you want to think about, how you're preparing for creating that income, how are you doing that now? Are you on the right track to hitting your goals at your time of retirement? So now is the time to start thinking about that, and it's never too early, as you can see from what Adam spoke about. And it's you just want to get started. The earlier that you start, the better. So how are we doing on those, on that poll, Miss Karina?
I think we're good. Let's take a look at the results.
Okay, can you
So I'll
just
read them
share them?
out to you again.
Absolutely.
So 32% responded yes, and I'm fairly confident in my plan. 33% I have, but it's been a while. 23% I know that I should, but I haven't. And 12% I don't have any idea where to start.
Well, don't be dismayed for those that know they should, but they haven't. We want to encourage you to do that. And for those who don't know where to start, throw us something in the chat box so that, we can know that you need some help. CapTrust is here, and we're going to give you all of CapTrust information at the end of the presentation. But let us know that you need some help, and, we'll make sure that you get the help that you need, because we are here readily available. We are waiting to hear from you. So let's just go ahead and continue. And now we are going to get to Jeremy. We want you to share the perspective. We're talking about planning for retirement, and you have that group that's 10 years out, and we're going to spend a little bit more time there on creating income, because this is a little more urgent. This is on the horizon when you're thinking about between the 55 and 65. So Jeremy, take it away.
Yep. So I think where is a really great place to start if you could advance the slide, Deborah, is talking about, since you're entering this decumulation phase of retirement, is matching up your income with your expenses and taking a deep dive into what's inside of each of those categories. So what is really important for both your income and expenses is to divide them each into 3 categories respectively. So what is in blue here are going to be maybe the guarantees or kind of the stalwart portions of both your income and expenses. And then what is in purple are going to be the things that can vary depending on what actions you take. And then what's in the light greenish gray color at the bottom are things that may be lumpy or one-time events. So I'll just walk through those real quick. So in blue on the income side, these are going to be things like Social Security, monthly pension payments, any variable annuity withdrawals that are systematic in nature. On the variable side, from an income standpoint, you have control over when you take dollars out of your retirement plans, your IRAs, your Roth IRAs, your taxable investment accounts and cash you have at the bank. And then there may be things that are lumpy from time to time, whether it's an inheritance or you sell a property. So just like you have the kind of guarantees, variables, and controllables of your income, same is true of your expenses. And we kind of say tongue in cheek that retirement's a 3-legged stool, what you save, what you made, but most importantly, what you spend, because it's the big thing in retirement that you have the most control over. Well, you're gonna have to food yourself, clothe yourself, you're gonna have to put gas in the car, pay the utilities. But other than that, there are things that you can control, your hobbies, how much you travel, the level of spending, entertainment, memberships, things like that. And then there will always be the large trips you take with you and your family, or other large purchases, be it a car, etc. And once you have a really detailed handle on your expenses, you can really take a magnifying glass to all of the ins and outs of your household. And one thing that's going to be really important to know is when it's time to take a hard look, specifically at certain ages. So let's walk through some of those key dates, Deborah, that all retirees that are entering in that decumulation phase should be looking at. So we'll start here on the far left. Age 55 is the earliest age in which you can take withdrawals from a 401k plan. As long as you've left your job or retired, you can do that. Age 59 and a half is the earliest age you can take a normal withdrawal from an IRA or a 401k plan, whether you're retired or not. Age 62 is the earliest age in which you can file for Social Security. And then age 65 through 67, depending on how old everybody on the call is what is considered normal retirement age from a Social Security standpoint, or even most pension plans and most retirement plans, that's considered normal retirement age in that window. The key thing about age 65 is you're entitled to Medicare coverage, and you should apply for it a few months before or after age 65 to make sure that you've got all your ducks in a row. Age 67, for the majority of those in this age group I'm talking about, that's going to be your full retirement age for Social Security. Age 70 is the latest date you can file for Social Security. And a lot of people have been delaying Social Security if they're able to, because you get an 8% raise, if you will, almost in the dollar amount of every year you delay from your normal retirement age. The key thing to decide there is, can you wait? And that's where taking a hard look at your income and expenses is really important. And then age 72, which is somewhat of a new fact, is that that's when retirement required minimum distributions begin from your retirement plans. It used to be age 70 and a half, and now it's age 72. So one person that's omnipresent in all of your retirement planning is going to be Uncle Sam. So if we could maybe take a slide further here, Deborah, we can dig in a little bit to some of the tax considerations that you need to look at in retirement. As we mentioned earlier, taxes would fall under those guaranteed expenses, right? Uncle Sam's always going to be there. So therefore, taking your personal family tax situation into consideration is very important in retirement. As Michelle and Adam both mentioned earlier, looking at Roth 401ks or Roth IRAs is a powerful tool to utilize tax-free withdrawals in retirement, as they're funded with after-tax dollars that grow tax-free and thus come out tax-free. The same is true for Roth 401k and 403b dollars, as we mentioned earlier. Another thing you can do is convert traditional IRA dollars to Roth in the lowest income tax years, typically early in retirement. And this is a tax strategy we utilize with a lot of our clients. The goal here, if you convert traditional IRA dollars to Roth, is to convert up to the next tax bracket, so you're not creating any other incremental tax situations for you and your family. And also note that if you sell an asset for a long-term taxable gain in a taxable account or real estate, etc., that's done at preferred rates. In other words, you're not necessarily paying ordinary income tax when you do that. Most people will have a 20% or 15% long-term capital gain rate, as opposed to taking an IRA distribution at your normal tax rate, which could be up to 35+%. So sometimes it makes more sense to sell a long-term capital gain asset instead of taking an IRA distribution. And taking the minimal amount needed from your IRAs or 401ks will kind of be the next priority in line, as those distributions are normally done at ordinary tax rates, ordinary income tax rates. Another thing to point out here is Social Security plays a big role, obviously, in your retirement income streams and your taxation. But the unique thing about Social Security is it has what's called this provisional income calculation. And provisional income is measured by a measure that the IRS takes to determine whether recipients of Social Security are required to pay taxes on the benefits that you're taking. And the calculation is basically 50% of your gross income with some tax-free interest added to it. That is how that income tax calculation is made. For most of our clients and most of us on this call, you arrive at a calculation where about 15% of your Social Security benefit is shielded from federal tax, which is better than 100% of the benefit being taxed, right? And then if you own rental property, just a little tip, you should own it inside of an LLC to protect you and your family. And that flow-through income can be additive to all of the income streams we've talked about here in retirement. So we've shared a lot of information so far, and I think it'd be remiss if we didn't double back to talk more about risks in retirement that Michelle already hit on a little bit. The biggest one here, and one that we talk about a lot, is longevity. People are living longer. According to the CDC, the average lifespan of an American is just shy of 79 years, if you can believe that or not. And I think Michelle had a fact that she was going to share with us on this as well.
I do. I've noticed this in my practice. You all probably have also. But in almost every country in the world, women outlive men, and the U.S. is no exception to that. Women tend to outlive men almost by 5 years. So wow. I just wanted to put in a plug. It's really, really important to have women involved in the financial planning for their households.
Yeah, I'll second that. It's very important to have all individuals that are making the financial decisions at the table when it comes to this, because, you know, no matter what, the more people involved, the more level heads, the more opinions you get at the table, the better. The next risk we'll talk about here is market risk, and it's somewhat inherent by having investments inside of your retirement plan or otherwise, that if you have equity exposure in your financial plan, when the S&P 500 is up or when the Dow is up, you may experience some of that. So just know that going in, that you need to make sure that you are right sizing that risk in your portfolio. Withdrawal rates are really important to talk about the risk of. Those can change, as we just saw. The required minimum distribution age just went from 70.5 to 72. So that's a great example of keeping a laser eye on what's going on with the withdrawal rates that you're required to take. Inflation is a super hot topic right now. Everyone's asking me, Jeremy, what does CapTrust think about inflation? Should I be worried about it? And the biggest takeaway from an inflationary standpoint is that you have equity holdings and you have non-equity holdings. And when it comes to inflation, looking at the non-equity holdings, specifically fixed income, again, you want to right size the amount of bond-like investments in your portfolio. And inside of those bond investments, you want to be focused on investments that have a short duration or very little investment, or excuse me, interest rate risk within them. You want to be focused on that. And honestly, the best thing you can do to offset inflation is to have the right amount of equities in your portfolio. So just keep that in mind. We're going to talk more about that right size between bonds and equities here in a little bit. Healthcare, obviously prices are on the rise. It's going to be very important for you and your family to make sure you know and are educating yourselves about Medicare supplemental policies. And if long-term care is something that you're interested in, you want to find the best pricing to get access to long-term care. And what's happened over the past, call it decade, is that pricing in the long-term care industry has become so high that a lot of people are simply getting access to that type of benefit via different types of life insurance. So that may be something you want to look into later. And then debt carryover. Everyone has to make a personal decision about how they feel about debt. Some people are extremely averse to it. Some people, it doesn't bother them. But when you're going into retirement, you want to make sure that whatever debt you're bringing into that period of your life makes sense for you and your family. And doing a deep dive of your cash flows and cash flow analysis will really help to answer that question as to whether you should pay things off or let them ride into retirement. And speaking of managing cash flows, let's talk a little bit about our bucket approach to investing. We spend a lot of time with our clients talking about buckets and how they can do their mental accounting in their head. And we at CapTrust use a lot of the research that's been done in the field of behavioral finance to influence how we set up a retiree's portfolio, and even a pre-retiree for that matter. We set up 3 different buckets for our clients when we're investing their dollars. When you're going through the accumulation phase and you're earning and you're that earlier part of the time frames that Adam talked about and then Michelle as well, you're probably more focused on the growth side of the portfolio, that far right purple bucket here. But as you enter the decumulation phase, it's important for you to start establishing that middle bucket, that income bucket, and also that capital preservation or cash bucket. Like Michelle said, that's going to be kind of your insurance for your portfolio, is that cash reserve, right? So if you're setting up 3 buckets, you might be asking yourself, well, how do you know what to put in each bucket? And the type of analysis that we do informs how you put dollars in each bucket. And the analysis I'm talking about is finding out what dollars from your portfolio are needed on an annual basis from a nominal standpoint. And I'm talking about years worth of spending, right? So if you look at the cash bucket, the one on the far left, we would recommend that an individual has no more than 1 to 2 years of nominal spending in cash or cash alternatives. This includes what you have at the bank, but also could include very short duration bond funds, CDs, money markets, things of that nature. Then as you move on to the right, the income side of the portfolio should be in nominal terms no more than 5 to 10 years worth of nominal spending. And our income portfolio idea would have no more than probably about 25% equity exposure, so about 75% fixed income, so still very foundational, safer investments. So if you look at, in dollar figures, what's between the capital preservation and the income bucket, you've got over a decade's worth of spending in very safe, secure instruments. So when, not if, but when 2008 happens again, because we know something like that will happen in the markets, you're not losing so much sleep about where's my spending coming from over the next decade. And then you have the growth bucket. So everything in excess of that decade's worth of spending should have more of a growth bent to it, because you're not necessarily going to be pulling dollars from it for spending needs, and it has the time window to endure the fluctuations like last March or like a 2008. So between this type of strategy, by trifurcating your money and doing some mental accounting in real terms in your portfolio, it should help you sleep better at night. It should help you feel a lot more comfortable with the way that you're structuring your portfolio into retirement. So back to you, Deborah. Thank you so much.
Wow, this has been great. I could carry this conversation on for another 2 hours. Okay, don't be alarmed. We're gonna finish this up. I'm gonna wrap this up in a slide or two because I really want to spend some time getting some questions from the audience. But I do want to just say that, you know, you're gonna see there, right, this slide that we're showing is going to show some common income sources for today's retirees. And so what we want you to think about is what's going to be your sources of income in retirement, how much of your needs are they going to cover? And as Jeremy noted, part of that's going to be Social Security, which was never meant to cover everything. Working could be a source, whether you're still full-time or part-time. Retirement plans are what more and more people are going to need to rely on. So when you're looking at your next steps, remember that there are varying degrees of things that we have control over on our retirement planning journey. And then some of the things we have total control over, as Jeremy noted earlier, and Michelle, and we've all noted, we have, and Adam, we have control over how much we save. We have control over how much we spend, how we manage our investment strategy. Here, you want to just call CapTrust if you're having questions about that, you're not really sure, call us. But what I really want you to focus on is what is within your control. You want to check your progress from time to time and be sure to include all of your sources of income, because sometimes we may forget about a source that we have. Consider all of that and remember that you have access to help because we are here to help you. I want to put up this contact slide and we're going to have this contact slide to stay up where you can call CapTrust, go onto the website, you can make an appointment. And I still want you to be reminded, I know that we gave you a lot of information. And remember, you're going to get a copy of this recording. We're going to send out a survey because we do want to hear from you. We take your feedback very seriously. So we want to know how you felt about the information that you received. Was it helpful? So you will get a survey. But before we close out, Wes, are there any questions from our audience today? I kept seeing that little light flash up for questions, so I'm sure there's something in the chat box.
Yeah, great point, Deborah, and thank you all for attending today. I do want to mention there are some handouts in the interface, so make sure you grab those handouts. Go ahead and download them. They great summary of the information that we've discussed today. We will be sending out the recording in the coming days with those handouts as well. So if you don't get them now, it'll be okay. With over 1,300 people on here, we've getting a ton of questions, and if we don't get to your question, give us a call. Set an appointment. We can talk about your personal situation and not just talk in generalities. But I've been trying to grab some of the themes that we've been getting to try to toss some of these questions. So I'll go ahead and just toss this first question up, and it's about starting late. You know, if I've gotten a late start, what would you suggest? Should I invest more aggressively to try to play catch up? You know, can you give us some thoughts on just getting a late start?
Who's going to take that one?
Yeah. So first of all, it's never too late to start. And the next step is to meet with a CapTrust counselor and figure out what's the plan. You know, get a plan together, figure out how much you're going to need for retirement, and then work on meeting that plan. So you want to look at what assets you do have and how you can deploy those assets to have the most successful retirement. But the key is it's never too late to start and get a plan together.
Yeah, I'll echo what Michelle's saying. I think what's really important if you're getting a late start is to do the math backwards, right? So you know what kind of lifestyle you've currently created for yourself. Take a stab at what you're going to need at the end of the rainbow, right? And then meet with a CapTrust retirement counselor to figure out how you can back into the math to know how you should be catching up. And sometimes there may be some difficult conversations that need to be had, but you have to have those conversations. You have to dig into the details so you know. And I think that's the big takeaway is get that plan done, run those numbers.
Thanks. On the flip side of that, I've gotten a lot of questions about retiring early. Some people want to retire before maybe they can get to their full social or even early social security age at 62. Some want to retire even earlier than age 59 and a half, the typical age. So I'll start maybe with you, Adam. Any thoughts about how people may be able to retire early and some things to think about if you are considering an early or even a super early retirement?
Yeah, that's a great question. You know, fortunately, there are many people who do set aside enough to put themselves in the situation to make that choice. So the overall thing that I would recommend looking at is if that is something that is on the horizon for you or that you're considering, is you have to factor in all sources of income that are available to you. So make sure you're looking at what is available to you at those early ages and what's not available to you. Also factoring in the expenses that you're looking at. There may be certain expenses that'll be higher if you're retiring early because, for instance, Medicare is not available yet. So you're paying private healthcare costs. So if you put yourself in a situation where you're able to retire early, that's great, phenomenal. But just make sure you are accounting for everything that you have to consider in terms of your income needs and the expenses that you'll have, because you're not going to have all the, for instance, options to pull from for income.
Yeah, and that actually leads into another question that's come up, and that's on Medicare and still working. Jeremy, any experience talking, with our clients, our participants about Medicare? When they can take it, what if they still work, and signing up for Medicare?
Yeah, so the key thing there again is to get the numbers together, right? You want to be armed with all of your facts. So signing up for Medicare, you get a nice window before you turn age 65 and a little bit of a window after there to make sure that you're getting enrolled. And I think it's just really important that you sit down with your HR group and have that conversation. Again, getting all the facts in front of you and making sure that you know how your employer plan interacts with the Medicare system and vice versa. So again, set that appointment with HR, make sure that you've enrolled when you are supposed to, and make sure that you know how the two plans work together.
Yeah, and also especially important if you participate in the high deductible with an HSA, that definitely comes into play too. And we've got a lot of questions about HSAs, and one person asked about, well, should I be using my HSA for medical expenses now, or should I save it for the future? Michelle, any thoughts around that?
Well, I like using the HSA for the future because it operates pretty much like a traditional IRA or Roth IRA rather. So if you can afford to pay to cover those medical expenses outside of the HSA, I say do that and make sure your HSA is invested. I've seen a lot of HSAs in cash, so you can invest the HSA in the equity and bond markets. So if to put that on steroids, get that HSA invested so that money can grow tax-free and you'll be able to take it out tax-free for qualified medical expenses in retirement. So yes, if you can afford to cover medical expenses outside of the HSA, that's the way to do it.
And then similar to that, should I contribute to my 401k or should I put more money in my HSA? Jeremy, any thoughts about kind of the order of contributions? We only have a finite amount of money and we got to figure out where that money goes. Jeremy, any thoughts about the order of contributions?
Yes, I think that it all depends on kind of where you're at from a budgetary standpoint, right? So I think for the highest earners that have dialed in to listen today, it makes sense to make sure that you're getting that deduction by putting dollars in your retirement plan pre-tax. It's extremely valuable. However, not everybody can do that, right? So if you have an option with $1, I would recommend that at a minimum in your retirement plans, you get that match, right? That's kind of the bare minimum. And then the discussion becomes the kind of waterfall of priorities, right? Where do I put $1? HSA programs are great. As Michelle said, it's triple tax free. But if you don't have an emergency fund funded, or you don't have basic things like excess disability insurance, these are kind of the foundational items of financial planning. So after you get that match, then it's time to kind of look at your bank account at home, look at your insurance coverages, and then do an HSA, right? So, you have the different priorities based upon where you're at in life.
And I also had someone mention about HSAs, aren't they use it or lose it? That's actually the flexible spending accounts that are use it or lose it. Health savings accounts, and our benefit provider at CapTrust likes to really stress those words. Savings accounts are meant for the future. You're saving this money, it carries forward, and these accounts are investable. Usually you have a list of investments that you can choose from, and there's a minimum you typically have to hold before you could invest that money, but then beyond that minimum, then you're able to invest. And I think another good question that came up is around the order of distributions. I've got pre-tax money, I've got Roth money, I've got these other accounts. Michelle, could you give us some thoughts on around, hey, what's kind of the money that you touch first?
Right. So the money that I like touching the money that you have in the uh, taxable accounts first, and I'll tell you why. Because if you have people who are inheriting, if you're trying to leave money to people, the next generation, that money that's in like your Roth IRAs and will grow tax free. This is going to just be on steroids, the money that they'll be able to inherit. So if you can touch that money last, that's always a good plan to work in with your estate plan. If you're not leaving the money, to someone, to the next generation, and you're just trying to manage your tax bracket in retirement, then what you want to do is look at what tax bracket are you comfortable in retirement, and how much do you need to take from your taxable accounts and your tax exempts to stay within that tax bracket. But if you're looking to leave money for the next generation, then I say let the tax advantage accounts grow as long as possible.
And the other thing everybody has to then take into account is required minimum distributions. And I think we did hit on this, but I did have some people saying, hey, can you just, go over that again? Adam, can you talk for a moment about, again, just basic, what is a required minimum distribution and why it's so important that you take those?
Sure, yeah. So the government ultimately wants their taxes. These are great accounts to defer these taxes or have tax-free growth, but inevitably the government wants these taxes paid. So as Jeremy mentioned earlier in the presentation, at age 72 is that required minimum distribution age. And it's formula based on your balances, life expectancy, and typically falls to 4 to 6% in terms of what will need to be withdrawn at that age. But as Michelle just mentioned, your Roth IRAs, they do not have that required minimum distribution age. So if you're in a situation where you can defer the withdrawal of those accounts and let them accumulate and build, that'll help you overall and long term.
Yeah, and I know there's been a lot of talk about, so in case you weren't familiar, the RMD used to be 70 and a half, and now it's 72. And there's been a lot of talk, do they even need to do that? Because most tend to take more out of their accounts than what they are required because they need that money to get by. So it really isn't that much of an issue. But yeah, you don't want to run into those situations because the government hits you with a 50. Yes, I said a 50% penalty on those RMDs if you don't take them. And you've worked too hard for that money. You don't want to give it all to the government. So, and a lot of times your providers have tools to make sure you are getting those RMDs out, with setting up automatic features and things like that. So also, I got some questions around Social Security. You know, one individual asked, should I just take it at 62? Why should I wait? Jeremy, can you talk about why you may want to consider not taking it at 62 and maybe why some people do consider taking it early?
Right. So again, it's all situation specific, right? Everyone has to do what is best for them and their family, and cash flow is king. So you want to take a hard look at what you need at what point in retirement. But you may want to consider not taking it early because, as I mentioned, by waiting from age 67, for those of most of who's on the call today, to age 70, every year you wait past full retirement age, you're getting an 8% addition on top of what you normally would have gotten for every year that you wait. The same is true on the other end. It's not a penalty, it's just a smaller benefit. And the key takeaway here is it's that way forever. So this is an irrevocable decision. If you take your Social Security benefit early, that is the benefit you will be starting at for the rest of your life. So you just want to be 100% sure that you're okay with that. And someone also mentioned retiring early instead of later. So when it comes to making the decision, can I retire early? It's these types of early benefit changes that will dramatically impact how successful that situation would be. So again, all back to the facts and circumstances, make sure you know exactly what you're getting into.
So we're going to go with a few more questions here. We'll take it, at least to a few minutes, to the hour at least. And I did want to mention again, if you do have to go, we will be sending out this recording with the handouts. Feel free to grab the handouts in the handouts pane. When you leave, there will be a survey. This is how we mold our content for these future quarterly webinars, is from your feedback. We want to hear your feedback. And another big question I got is, well, do I got to pay for a consultation with CapTrust? No. If you're on here, this is part of your benefits. Your employer has added our participant advice service as part of your benefits. So use it. Give us a call. Set an appointment. If you want your spouse involved, we always, as we've talked about, have them involved in the consultation so we can talk about what's going on for you as a household. I've gotten some questions about annuities. Hey, does an annuity possibly make sense to annuitize some of my money? Who would like to take the annuity question or talk about annuities for a moment?
I'll take that, Wes. So annuities can have kind of a negative connotation to them. We kind of joke that most annuities are sold, not purchased, but that is not always true, right? So everyone has to look at your own situation, and the key thing to know about annuities is the costs involved, because you're taking a portion of your assets and you're giving it to an insurance company, and then they're basically giving you an income stream for you having done that. So the insurance company is going to make money off that transaction, and most of the time, whoever's involved that's helping you put the money in the annuity is getting compensated from that transaction as well. So as long as you understand what's involved, what the internal expenses are to the annuity, who's getting paid, how are they getting paid, how are you getting paid, right? You're doing this for yourself to get that income stream. As long as you understand and know all that, it's fine. And a lot of people who maybe are behind the ball on saving, an annuity can be a very cost-efficient, cash flow efficient vehicle to create a guaranteed income stream in retirement. But again, they're not right for everyone.
I just want to add on there that, you know, as Jeremy mentioned, you're giving your pot of money to the insurance company. So you want to also make sure they're a highly rated insurance company that you're working with for the annuity.
Yeah, great point. I also had some questions about expenses and, should I pay off my mortgage as I'm getting closer to retirement so I don't have that expense? Should I accelerate my mortgage payoff? Michelle, any thoughts around mortgages and retirement?
I do. Having peace of mind in retirement is a big benefit, financial benefit for you. And so, as Jeremy mentioned earlier, it's how much debt you carry into retirement is a personal choice. But I have to tell you, from all my years' experience, I've never had a client say, gee, I wish I hadn't have paid off my mortgage in retirement. So I would highly recommend to, pay off the mortgage if that, if you're so inclined. I wouldn't accelerate payments unless I've taken care of all my other retirement savings. But if you have some discretionary income, that's a good way to use it in preparation for retirement.
Excellent. Some great discussion that we've had here today. I also got some questions around life insurance. How much life insurance might an individual need? Any thoughts around life insurance? Jeremy, any thoughts, about basic life insurance needs or, tools or things people may want to look at when it comes to life insurance?
Yes, absolutely. So life insurance is typically a big topic with our clients because I kind of make a really cheesy analogy that you want to kick a field goal with your life insurance coverage, right? So at the high end, the upper end of life insurance would be replacing your entire lifetime of earnings, taking care of your children and all their education needs, paying off all your debt, everything like that. And then at the other end is help your family mourn and pay for a funeral, and that's it, right? So you want to kick a field goal somewhere in between. And again, just like the annuity conversation, so much of the life insurance conversation comes down to cost. So once you arrive at a death benefit that's appropriate, for most of our clients, help pay for college costs, pay off your debt, and maybe leave a little bit of a legacy, but you're not necessarily trying to replace your entire lifetime's worth of earnings, right? But to do that, for most individuals, having a level term policy tends to make the most sense. And depending on your situation is where that death benefit amount would be. That tends to be the most cost-effective way to access life insurance as well.
And I always say around life insurance, always know what you get from your employer. Make sure you take full advantage of all of your benefits, including the benefit of access to independent objective advice from CapTrust. So we're at the hour. I do want to get ready to wrap up. I'm going to go ahead and toss it back over to Deborah to wrap up and thank everybody for their time today.
Wow, this has been great. Thank you, everybody, for your time. And I did just want to add one more thing. Go out to captrustadvice.com. We have a great calculator out there for estimating the amount that you would need for life insurance. But I cannot thank my guests enough. Jeremy, Adam, Michelle, thank you for every moment that you spent preparing for this, all the calls that we had and how I was worrying you all to death. But thank you. But I think it was well served for our audience. Thank you for coming. Remember, you're going to get a copy of the recording in 24 to 48 hours. You're going to get a survey. Please, please, please make sure that you fill out that survey because we really value your feedback. Thank you for attending, and we will see you next quarter. Next quarter, our webinar will be on cybersecurity. So I welcome you to look for that invitation in the coming weeks so that we can talk about that as well. But thank you, everybody, for coming, and have a great day today.